A little groggy, having just returned early this morning from New York City, but I knew we missed Monday's open mic, so I definitely didn't want to miss two in a row. We're going to do a little stock screening today on open interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk about the markets and take your questions. And I was asking myself this question a little earlier today, why it is, if there are factors that are demonstrated to work over big data sets, over large periods of time, why is it that a lot of people who are making stock recommendations do not talk about that more often and think about how some of these things work and how they may or may not work together, but also how you can use it to begin to sort of formulate a list of stocks from which you might decide that you're going to start creating some trade ideas. And as I alluded at the very beginning, I flew to New York on Sunday night. My flight was considerably delayed. I had a speaking engagement in the city, and actually we were attending a conference. And I ended up getting into New York around 2 o'clock in the morning or 2:30 in the morning or so on Monday. And then coming back last night, I had a similar sort of a delay, and I didn't get in until about 2:30 in the morning. And of course I trade, which means that if you are on the West Coast and you trade, you are up at 5 o'clock in the morning, which means that out of the last 48 to 60 hours or so, I haven't really gotten that much shut-eye, so please forgive me if I am a little bit disjointed as I speak to you now. If you can see my screen, I'll tell you what it is that I'm working on, and hopefully we can share that. I'm going to actually go back to my Bloomberg terminal first, because I want to just illustrate something, and then we will, so let's do that. Sorry, flip over here. Okay, I think you guys have seen these screens before. All right, so we're just going to focus on a couple quick things. And just for anybody who's watching this for the first time, or for those who have seen me go through this kind of thing in the past, but don't remember exactly what it is I'm doing here, let me explain. So one of the nice things that a Bloomberg terminal offers is a lot of data going back in time. And you may have heard the term, factor investing. What you're basically doing is you're taking a number of different quantifiable criteria, things that you would know ex ante, so before you effected a trade, and you can go back and say, okay, well, how would trades based on these decisions applied systematically have performed over time? And one of the important things about doing factor research in this way is that you have to actually break the factor into subsets so that you can compare them. So let me give you an example. You could say something like, okay, does price to earnings ratio, that's probably the most common valuation metric for most people who invest in stocks. They've all heard of a PE ratio, which is just the price of the stock divided by the earnings per share. So if a stock is 100 and it is earning $5 per share, then it has a PE of 20. 100 divided by 5 is 20. So you could say, does price to earnings matter? A lot of people will say, well, I like a low PE ratio, or they might say, I like a low PE ratio relative to growth. But when you're doing factor analysis, it isn't really sufficient. You could do something like a scatter chart, right? So you could actually plot the forward-looking returns relative to the price-to-earnings ratio. That would be one way to begin to think about how that as a factor drives returns. Another way to do it is the way that the factor feature in Bloomberg does it. Now, I've done it in both ways in several different contexts. But the way Bloomberg does it is it says, okay, well, we're going to take a factor, and then we're going to divide that factor into quintiles. So in this case, I'm looking at the Russell 1000, which is the largest 1,000 publicly traded stocks in general by market capitalization. And then you take a look at a given factor, and then you just rank it top to bottom, and then divide it into quintiles. So 200 stocks effectively in each basket. Now, it may or may not work out exactly that way because you can sometimes have stocks that have more than one share class, so you'll have two tickers that land inside of a subset or funny things like that. Goog and Google, for example. Both are Alphabet. One's a voting share, the other one isn't, but otherwise they're essentially the same stock. We see that in a couple of media companies too. So I think in the Russell 1000, there's maybe 5 companies that will appear twice because they have two share classes. All right, so once you have divided it into quintiles, then you evaluate the monthly performance of stocks within those respective quintiles. Now, bear in mind that over the course of time, stocks will migrate into and out of a given quintile. And so what this gives us is a little bit of a trading strategy, right? So you could say, well, I'm only going to buy the stocks in the top quintile and see how that does. So that's what we're looking at right here. And I actually chose only 3 factors, and you'll see why in just a minute because I'm going to take this data and then drop it into another spreadsheet so we can think about it. And there's some intuition as to why these factors might work. So in this case, we're just taking a look at something that is news driven. And in this case, we're talking about analyst earnings revisions. So this is a measure of the forward revisions for a given company from sell-side research effectively, the number of positive revisions over the course of the last 3 months. And a positive revision is going to end up in the top quintile, and the ones that have downgraded their earnings estimates the most are going to end up in the bottom. And here's a result. So this is the Russell 1000 going back 5 years, and here's what the monthly performance looks like for companies that are in the top quintile versus the bottom quintile, right? And you can see that there does appear to be an important relationship here. And that stands to reason. In other words, if those who are evaluating, how good a company is to invest in, if they keep raising their estimates for how much the company is going to be making, that suggests that the street may have underestimated what the company was capable of doing in the past. And so those companies would reasonably be expected to outperform. And similarly, the ones in the bottom quintile, those are going to be the companies that the street had consistently overestimated how well the company was going to be doing and are now adjusting it. But these are all things that you know at the time. And if the only thing you ever did was buy an equal weight basket of those with the highest positive revisions in the Russell over the last 5 years versus the bottom, this is the divergence in performance you would have seen. So this is how the top quintile performed, and this is how the bottom quintile performed. And this would have been your performance had you simply been long the best group and short the worst one. Is it a perfect horizontal line? No. But I would say that's a pretty good result, right? So we would be very happy if we had invested and that was our strategy. We would have had some setbacks. You can see that right here in 2022. You can see that it fell down in this neighborhood. We got down to up about 23% from up 40%. So it gave back a considerable portion of the money that it had generated from here to here. But then, after you had that setback in 2022, we had, an intraday bear market at least, pretty much resumed. Okay, so on the basis of this then, it would seem that we should pay some attention to whether or not analysts on the street are adjusting their estimates. Okay, let's pick another factor. How about technicals? We've all heard the expression, nothing good happens below the long-term moving average. You will know that my friend and colleague, fellow CNBC contributor, Carter Worth, who runs Worth Charting Group, who runs the Worth Charting Option Income ETF, ticker WRTH, that he uses a long-term moving average. In this case, I'm using the 200-day because that's already preloaded into Bloomberg. And it's not that dissimilar to the one he favors. His own research, and he's been working on this a long time. He started in the business in the 1990s. And by the way, a lot of people don't know this. He started off on the fundamental side. He started off at at Value Line, and then DLJ, Donaldson, Lufkin, Jenrette. Boutique investment bank, very well thought of. In fact, I actually worked with a number of DLJ people myself when I was at Ivory Capital many, many years ago. So pretty smart bunch of people there. Here we're looking at the 200-day, and if you take a look at the price relative to the 200-day, you can see that the top quintile definitely outperforms the bottom quintile. And like I said, nothing good happens below the long-term moving average. Well, if you're well below the 200-day moving average, apparently you're not making any money at all. Now, this isn't quite as consistent as the other chart was, but we can see that if you were long the best group and short the worst one, this is essentially how you might have performed. Okay, so we have earnings revisions. What's the sell side telling us? What's information that's coming to us by people who are supposedly well-versed in these companies? Technicals, that's obviously observable. What else is observable? Well, we could take some basic fundamental metrics. A lot of you watching know that I have a tendency to care about things like free cash flow. One measure of free cash flow, it's not a perfect measure of free cash flow, but it's often used as a proxy, is EBITDA, earnings before interest, taxes, depreciation, and amortization. Now, what are the reasons why it's not a perfect proxy? It's not a perfect proxy because taxes can be a real cash expense, and interest, both expense and income, is also quite real. Also, I don't think that it's entirely appropriate to do things like ignore depreciation and amortization, but from a cash flow perspective, these things are going to usually track pretty closely to one another. So enterprise value simply being the value of the business once you take the net cash or net debt out of the equation. A little bit like valuing the house without considering the mortgage that the holder has on it or how much cash they have hidden in the basement. If you really want to know what the value of the house is, you focus on it without including those things. And so that makes sense. So EBITDA to EV, I think most people, when they talk about this ratio, usually you'll hear it described as EV EBITDA. So if somebody says, it has EV EBITDA of 10, what they really means is that the company's enterprise value is 10 times the earnings before interest, taxes, depreciation, and amortization. But in this way, when you invert that ratio, you're effectively talking about a form, it's kind of like a form of a free cash flow yield. So the higher the EBITDA is, the higher the free cash flow yield is. And they probably have this metric somewhere else. But once again, we see this same pattern. And that is that companies that are in the top quintile are materially outperforming ones in the bottom. Do they always outperform? No. But on balance, you would certainly prefer to own this white line, that is high EBITDA to EV, versus the yellow one, which is the lowest quintile. And here's the performance. And this sort of shows that, these things can come and go. So outperformed here, but then underperformed for a period there. And actually, I need to go back in time a little bit more because that's just 1 year. Let's look at 5. I think this is probably a better test. Look at a real period of time. So is it outperforming all the time? No. But on balance, I think it's safe to say that we prefer owning companies that are generating more free cash flow versus less. And actually in the bottom tier, this group right here, which is companies that over the 5-year period didn't generate any returns. They actually had declines on balance. That's probably not really all that surprising either. Okay, so once you've done this, one of the things you can then do is say, all right, well, I want to combine all of these things and start. So when I look to combine these, I want to make a really important point. And that is that when you're evaluating this, you're looking at 200 companies and just rolling and adjusting that position monthly. When you start dissecting this, that does not necessarily mean it, just because it is true that owning higher free cash flow is generally better, that buying companies above the long-term moving average is also generally better, that buying companies that are getting positive earnings revision is generally better. That does not mean that you can just simply say, okay, well, I'm going to take all of those things and, create a super trade. The Frankenstein that you create when you take all of these things and put them together is not necessarily going to be an improvement. But because we do have some intuition about these things, at least we can begin to use that as a starting point for how we're going to, take a look at these things. So what I was actually doing right before we got started, and I actually have to eliminate one of these because, so I just want to make sure this is 5 years. Now it's 5 years. This is 5 years. That's 5 years. Okay, so this one right here, which is the, okay, so this one I actually have to adjust because this is what I was looking at. Because when I downloaded this, I accidentally downloaded a 1 year. So I'm just going to view these securities. And we're going to just drop these into an Excel sheet. I have this list. And I'm going to combine that into my other one. This tab's got to go because this one was no good. That's only 1 year's worth of data. I don't want that. Delete that. Add this in. And now we're just going to take a look at some of the names that are in this list and go from there. So I'm going to throw this into my sheet. And incidentally, I mean, this is something that I'm sure you probably can get out of a lot of other applications as well. So we've got the EBITDA here. So why don't we just take a look, and we're going to see which of these names actually might be in the top quintile and see whether, who knows? We might find some stuff that we say, okay, that makes good sense. I can see why I might be interested in doing a trade in this area. So I'm going to do that. That. I want an exact match, of course. Here I don't, because these are not otherwise ordered, I don't really care about this. All right. So let's go and see what we have. Who knows? Maybe there's, let's see, we'll be, I'm going to look for, I don't know whether there's something that happens to be in all of these. Looks like there probably are. See what we got. Now suddenly we have a list of companies that have seen positive earnings revisions. They are strong relative to their 200-day moving average. A couple of these are in the energy space. We know that there's something idiosyncratic going on there because we've seen all of this volatility going on in the Gulf. Not really surprising to see Micron generating as much cash as it is. We know that the stock is extremely strong, and we know, of course, that people have really been struggling to keep up with, the rapid pace of their improving revenues, improving free cash flow, and improving earnings. But what we've ended up with here is a list of stocks that could be interesting. So I'm going to put these in here for everybody's edification, and perhaps you guys have some interest, or if you want, you can just throw it in the chat and we can slice and dice this in some other way. And with that, I'm going to start getting into your questions. I'm going to actually sort this by the sector first, and then sort it by the security name. So there we go. So here's a list, if you're interested, of 20 stocks out of the Russell 1000 that all are in the top quintile with respect to sell side earnings per share, forward-looking revisions, all trading well above their 200-day moving average, and all within the top quintile of EBITDA to enterprise value. And again, like I said, there's a couple things here that should not surprise you. Maybe it's not that surprising that there is only one airline on this list, and it is the one that most people believe is the strongest in the space by quite a lot. It's also the only one that owns a refinery. So I don't know. Maybe that's partially an energy play as much as it is an airline play. So anyway, just something I thought I would just remind everybody of as I was thinking about it. Okay, so let's start right here at the bottom. Ed, any chance you're looking at IONQ after earnings today? I will certainly be looking at it. Here's the thing for us, and when we trade, and that is that the problem here is that it's not a small company, but it's not particularly big either. I mean, I think, what is this, like 15 billion bucks or so? 16, just short, right? So a little tough for us to play in this space in terms of its size. You know, in the fund where I'm involved, we're typically looking at, you know, large, really mega cap companies for the most part, but $50 billion is probably the lower end of the size of the companies that we're typically looking at. But I do think that it's getting. Let's actually take a look. Their numbers came out after the close. Has this thing started to move yet? Let's see. Yeah, it looks like it's 2.5% higher, something like that. I mean, it's trading almost 41 bucks now. And how high was the implied volatility? Chunky. Well, first of all, it looks like whoever was selling, if you were selling some premium on this thing going into the print, probably a nice win for you already. But even net of that, my guess is that you probably have a good opportunity to sell a little premium in this first thing tomorrow as well, depending on your perspective here. Let's take a look. Let's take a look at the technicals first. I mean, we really should be looking at this tomorrow because it may take a little bit of time. They're probably having their conference call right at this moment. So I will take a look at this in the morning. I think it's unlikely that we'll be trading it just because of the company's size. But yeah, I mean, to my eye, it looks like it's probably a good opportunity. 80, I mean, vol's going to come in, but 80 vol, if it catches like a modest bid. I will also say, though, that I have observed, and probably you guys have too, that it feels like the bar is relatively high in a lot of places. That, good news is, other than Microsoft, arguably, good news is being greeted with like, oh, that's nice, and meeting your numbers, or a slight disappointment is getting pretty soundly thumped. And that's probably not that surprising. We're not that far off of all-time highs. And some of the valuations forward-looking for some of these companies. Apple was the one that we touched on a week ago. That was turned out to be a pretty good bearish bet that we made in Apple. And by the way, if you did follow that trade that we talked about, the puts for, the August puts for $2.25 is about where they were trading. They went up to almost $13. I definitely think it makes some sense to. I actually posted that on X yesterday or the day before. I'm not sure when I might have posted it Monday. Either way, if you don't follow me on X, you might want to do that because I did suggest that it probably made sense to monetize and potentially roll some of that. Okay, MDM, what do we got here? All right, are we now risk on? Yes. Or do you still see seasonal or technicals ahead that make you wary? Well, risk. So are we now risk on? So are we talking about just me and the handful of people who are watching right now, or are we saying we as in the market more broadly? The market remains risk on. I saw an interesting statistic. I will read it to you. And that was that margin balances. Let's see if I'm going to find exactly where it was and read it. If I can find it. Where did I put this? This was a note I had actually shared earlier. Unfortunately, because there's a chat in here, I cannot just show that on my screen. But actually, I might have this somewhere else. Let me see if I can find it. I will read the quote. Whoops, can't do that. For compliance reasons, unfortunately, there are some things I have to... Okay, so Schwab, Interactive Brokers, and Robinhood margin loans were, as of the most recently reported period, now at a combined $283 billion. And that's up 21% in just one quarter. And all that while the S&P is sitting only a couple percent off of all-time highs. And so those three brokers, they're still growing accounts, still growing AUM, but the point that was being made by the person who posted this was that, you know, retail is still pretty much in a risk on mode. So when we think about are we, you know, still risk on? We being, you know, the broad market. The answer collectively to that is yes. However, I would just offer the following, which is that as I take a look at it, and it'll be interesting to see, this is what my eye was seeing. I actually talked about this recently. I put it into an article, and those articles are free, by the way. If you go to cnbc.com/options-action, I write 3 articles a week in there. Usually I'll put in a short options trade idea or something like that. But I was highlighting this in particular, which is that healthcare, financials, materials, and industrials were all showing improving relative strength. And where is materials on this list? That's real estate. Where are materials? I'm leaving energy out of there. Not sure where that is. It must be obscured by something in here. But materials, too, were on my list. So I was looking principally at healthcare, financials, industrials, and materials. And I was kind of leaving financials out a little bit because I tend to just be a little bit less interested in speculating in that space. Getting as whipsawed as it tends to by, you know, people swinging opinions about, you know, fiscal and monetary policy, and also the fact that there tends to be a lot more leverage on those balance sheets. So I was looking mostly at healthcare, industrials, and materials, and away from information technology, IT. And this is what I was talking about. So, you know, when did earnings begin? This is basically weekly periods. So we basically started right here. And what you can see is that, you know, this is 3 weeks ago, 2 weeks ago, 1 week ago, and here we are today. This is what I was talking about, that, you know, we've been seeing a lot of these companies report, and a lot of them have come a long way over the course of the last couple of years, and I just feel like they're getting a little gassed. That's what it looks like to me. And the reason the S&P is still holding up well is because there are other areas that have been strengthening. I think I've mentioned this on more than one occasion, that the Dow Jones US 100 Dividend Index has materially outperformed the S&P so far this year. And that's a basket of stocks that includes, you know, the names of like Kimberly-Clark and Procter & Gamble and, you know, Coca-Cola and things like that. So kind of your dividend aristocrats. And if you are interested in staying invested, you want something that's going to pay you dividends, and you're feeling like the technology trade's getting a little tired, that's where you're going to rotate into, and that's exactly what seems to be happening. You know, these are the companies that are traditionally going to be paying slightly better and bigger dividends. In energy also, energy is usually a pretty good payer, and you can see that's been lagging, but this is where we've been, right? So a couple weeks ago, back here, and now we're up to over here. So on a relative basis at least, staying in there. I think it's very difficult. That's not very difficult. I mean, it's almost impossible to time the market perfectly. So I don't like to tell people, gee, I think the S&P is running out of gas and you should sell all your equities. A lot of data shows that it's a fool's errand to try to top tick the equity market. In past years, I have from time to time tried to time the market a little bit more. I certainly, in my earliest days, was completely underinvested in the late 90s because I just felt like this is ridiculous. These companies are not worth this. And so, I watched a lot of people make a lot of money, and I did not participate because I just could not fathom how you could buy companies at crazy multiples. Call Cisco would be one of those. Or no multiple, where they didn't make any money at all. Pets.com or whatever. Why were people buying these things? So instead, and the way I handled that was, okay, well, the whole market's going to roll over. And then the whole market did get hurt a little bit. But the truth is, just make sure you're rotating into stocks that you like, and that'll be fine. And, do so in such a way that you can live with some drawdowns or pullbacks, and it's not going to get you all panicked. So, FinWest, how was your New York City trip? Well, it was generally pretty good. Other than my flight delays going out and coming back. So that was not so great. I would rather have been in Hawaii with my family. In Maui, that would have been a little bit nicer. They are back. I am back. It was warm and humid, I think, in both places, but I think I'd rather be warm and humid on the beach than, on 42nd Street. So, FinWest, you should take NetJets next time. Yeah, right. First of all, I have not flown private that often. It's been pretty infrequent. And I'm never the one who makes that choice. When I have flown private, it is because somebody else that I am traveling with has made that determination, and I've been fortunate enough to tag along for the ride. And frankly, with Jet A prices where they are right now, that would have been pretty pricey, I think, to go across at this point. On one of the most recent trips I did, and it was not a long trip. I was going from San Francisco to Los Angeles. A friend of mine said, "Hey, going down for the day." He has a jet, and said, "Hey, you want to go with me?" And I was like, "Sure, why not?" We took the boys, and we went down there, hung out for the day, had some lunch, and came back. And I did offer to chip in for the gas, and fortunately he said no. It's like, seriously, he's like, don't forget about it. And a little bit of a breathing a sigh of relief because fuel costs are up. I sweat just taking my car to the gas station and filling it up with premium, which is a 3-figure exercise every single time I do it. So, yeah, NetJets, I don't think so. But if any of you guys are going someplace and I happen to be going the same way and you'd like to give me a ride, I happily accept. We can chat the whole way. Reach out, especially if you're going to Maui. Okay. Dinesh, thoughts on Netflix dumped badly year to date? Yeah, I do have thoughts on Netflix, actually. And I'm not sure. I thought we had talked about this a little bit last week. Did we not? I wasn't sure if we had or not. My attitude was, I think we're getting to a buy juncture here. Because we really haven't had too many opportunities to buy this one at these kinds of multiples. I feel like, this is a situation where, and you guys can decide for yourselves, but everybody I know has, a Netflix subscription. Actually, I can remember distinctly. So I'm going east. My family is going west. They're going to Hawaii. And I got multiple messages like, give me the code that Netflix just sent. They were getting on a plane, and they all were logging on to Netflix, right? So that, by the way, being one of the nice things, if you're going to Hawaii, people who fly there will probably know that you can actually, you get like real Wi-Fi. It's not like United coast to coast in the United States where it says, oh, you can text, you can use iMessage. No, you can get on your Netflix, your YouTube, or whatever when you go there. It's kind of nice. But that was one of the things that it occurred to me. Is that, yeah, we're not getting rid of the Netflix subscriptions anytime soon. So let's take a look at forward PEs and look at it over some course of time. And I'm going to hide this. And well, I just got rid of the revenue, but revenues, that's not a bad line, right? This is the estimates, by the way. Okay. Now this is the earnings estimates, which are a little bit weak, but you can see this is cyclical, and this is not a log chart of earnings. But let's just assume that the revenues proceed apace, which is good. So I'm going to hide that, and I'm going to hide the earnings per share simply because I want to put this into perspective. Right? So this is the forward earnings multiple for Netflix. You know, what the hell? Let's go back. Let's see how much data we've got here. So here's where we're at. Okay? So I'm just going to choose this. And that worked out nicely. I want to shift. There we go. Okay. So there you go. 20 years forward multiple for Netflix. Now, do I think that Netflix can get back to the kind of growth that it experienced within various periods back here? No. But this thing is trading at a sub-market multiple. And I don't, to me, that seems very reasonable. So I think people can start taking advantage, frankly, of this. Is it going to do one of these things again? No, I don't think so. But I do like the company. I think they have a big moat. They're best of breed, which if you're going to invest in any industry is usually a good place to start. It's like saying, oh, I'm going to invest. Yeah, I said before, I'm not that crazy about investing in the banks, but if I had to invest in one, what might it be? 3, 2, 1, you get to guess. JP Morgan, okay. I can go along with that. I could go along with a Morgan Stanley or Goldman Sachs because they are the best of breed in their respective space. Morgan Stanley focusing a little bit more on the asset management and less on investment banking than they used to. Goldman a little bit more sales, trading, and investment banking. JP Morgan also a lot of the investment banking and also the more in the commercial space. So Netflix is the best of breed in streaming. So if you wanted to own the space, you wanted to own it at less than a market multiple, you want something that's continuing to grow as fast or faster than the market is. This is a common sort of thread of mine. Then this would be a place to look. You can see that the free cash flow, which was always something people were concerned about. They were always saying, "Oh, well, what are we going to do with Netflix on that front?" Because it seemed like content costs were always going to eat them alive. And here we are, right? So round numbers, $300 billion enterprise value. We'll call it 14.2. Free cash on 300 gets us to a forward free cash flow yield of well over 4.5%. Not bad. Top line growth, maybe carried by the likes of the NVIDIAs, the Broadcoms, and AMDs of the world. Could the S&P deliver year-on-year double-digit revenue growth? I suppose. But this is way better than the historical average, so kind of like it. Thoughts on Oracle long call. So Oracle, we did see a very interesting move, and this is a levered play. This is not one for me. And this goes right to the sort of best of breed conversation. So what's the best of breed? Who is Oracle trying to compete with right now? They're trying to compete with the other hyperscalers, but they don't have the same organic free cash flow growth, which means that if they don't get the addressable market that they anticipate, and this is largely, and what do they anticipate? They're expecting a lot of money from OpenAI, right? And OpenAI had a lot of deals cooking with Microsoft, and that relationship seems to have soured a little bit. So if Oracle was forecasting $300 billion coming down the pike from the OpenAI relationship, and OpenAI was depending heavily on Microsoft, Microsoft has tons of free cash flow organically on which they can have this massive capex. So obviously they don't have the huge free cash flow now, but that's because they have organic free cash flow and they've decided to make capital expenditures. Same thing with Alphabet. To a lesser degree, the same thing with Meta, and I say to a lesser degree only because they are taking on net debt, and Amazon. When I look at that, say that fivesome, Oracle's the weakest of these, and it just makes them a little bit vulnerable. Now, if you're going to make a bullish bet, I prefer, Bob, using long calls, because as the company becomes more levered, the equity becomes what? More volatile, right? So if you can imagine that the business prospects for any given company rise and fall, the more levered the company is, all else equal, the more volatile the equity is, which favors buying options rather than selling them. So if you see a company that is just generating cash hand over fist and doing nothing with it, maybe just buying back stock and accumulating more and more cash, you should expect volatility to decrease over time. And in the inverse is also true. As they take on leverage, then the volatility should be expected to increase. Only makes sense. Okay, so that is, I think if you're going to play it on the long side, and look, I know a lot of people who want it because it is a levered play. I've made this same sort of knock on Oracle in the past, and somebody said, yeah, but if you're going to make a play on the space, isn't that the levered way to do it? It is. That's the reason it's not for me, but that might be the reason it's good for you. And if it is, and you want a levered bet, then buying calls would be the way to do it. And we can see that too. I mean, take a look at how much this thing has moved. Let's do that. Oops, that's not going to do it. When it bounced over here, see? I mean, this doesn't look like much, but actually it is. This is a huge move. Check this out. So this is a 1-year chart, and you're saying, oh, it made a little bit of a bump off the bottom. Really? Oh, no, that's 30%. That was a 30% increase in the share price in just a couple of sessions, right? That is a huge move. So you can see that it is indeed the levered play, if that's what you're looking to do. But below the long-term moving average, I would argue in the least competitive position relative to the other hyperscalers, just simply because by virtue of scale and by virtue of their ability to generate free cash flow and the fact that they're not going to have as levered a balance sheet, as sexy if this thing catches a bid, no, then this thing will move more. If the whole space goes higher, and this one would move up at a higher rate, this is the high beta way to play it. But I want things that are above the long-term moving average, that aren't taking on massive amounts of debt, and that have a competitive advantage, not a competitive disadvantage, which I kind of feel like they have. So calls in the short term, long term, don't care. All right, Alex. I built a research tool that digs into FMP data for S&P 500 stocks to find names that match your selection criteria. Going to build another one with this new profile. Well, very good. I'm glad to hear that. And, I was thinking about this. I was talking to one of the producers and one of my colleagues today. Well, let me know. I'm very curious about your interest in this. What if, just on a social media outlet or something, we just distributed, each day, some of these sort of factors to watch kind of thing, and just update it. Like once a day, just do an update. Something like that might be helpful. People still have to do a little bit of their own curation work. And I can't technically say buy this, sell that. Officially, that would be a security recommendation, and just because I sit in a regulated seat, can't really do that. I can certainly share my opinions in general, but I can't make specific securities recommendations. Okay. CA667, do you think Apple is bottoming or will it fall further? Well, um, I don't know if you happen to see. I mean, obviously, I wrote the bearish piece on Apple a week ago going into earnings. I think I mentioned it here as well. The point I was making at the time was that it was just very fully valued. I mean, this was as rich a forward-looking valuation as we've seen in Apple in quite some time. And, you know, I needed to get considerably cheaper. They have a great business, and they're really in. They have a huge installed base, and they are in this really happy position where they're generating massive amounts of free cash flow. They're not spending it, and they get to watch all of these other market participants get out there and play, and they can sort of say, okay, well, you know, let's bide our time. But the valuation is just really difficult for me. I can remember when this thing was trading at a high single-digit multiple X cash. Remember what I was just talking a moment ago about how, as a company, delevers or accumulates cash, that the volatility drops. There was a time when this company was 40% cash and was trading at the single-digit multiple. More recently, it was trading at like 34 times, 35 times forward. Great company, but where are we going, folks? You know, like, what are you hoping here? You know, if you buy Apple, is your hope that it's going to go from a $4.5 trillion company to what? It's going to gain 25% in the next year? 25% is $1.25 trillion. That's a lot. That's a lot to expect. Yeah, it's not for me. I mean, you guys can kind of see. I mean, I look at things on a relative basis. There's a lot of good things to invest in. You don't have to pay that much. Nothing against Apple. And if you own something like SPY or some other broad market proxy, or you're putting money regularly into your 401k, trust me, you're getting plenty of exposure to Apple right there, because it's one of the top 10 constituents of the major indices anyway. And all the closet indexers hold it. So you own it anyway. Don't go and trade it. Okay. Oh, now you're okay. So now you're asking me about Microsoft and Amazon. So, Microsoft, that was clearly a great move. I think we're kind of, we got out of this. So you're wondering whether it's going to come back down in here. I think it could or it will, but I'm guessing it's not going to drop back into this level. You have this rising trend line. Oh, whoops. Yeah, so I'm looking at the wrong stock. That doesn't help you. So these things, yeah, I think these things go back down to their trend lines. But this one, I think, we're going to see this trend line reverse. I actually was already drawing lines on this. I should have known right away I was on the wrong thing, because I was already taking a look at this big move that we saw here. The interesting thing, though, about Microsoft, and actually, what did IGV do today? Because this is really also kind of a software sector issue. So this has bounced back a bit, largely because of Microsoft as a constituent in it. But the important thing to remember with Microsoft is that I actually want to create a bigger, longer chart here. Is that it still has not gotten back to its all-time highs. So this is sort of how software is doing in general. Microsoft's chart is probably not going to look a whole lot different than this, being as it is a big constituent in here. So I do think you could potentially test this, but I also see, if you're looking at the green line here, these lines, what we're seeing is that the shorter term moving averages are going to start heading back this way. That is my belief. I think this move, for the time being, is largely done. And as further evidence of that, I can't go to that because it's actually going to show the trades that haven't been posted or filed overnight, whether they will be updated. How about I put it to you this way? We're short strangles in Microsoft. I think that probably tells you what you need to know. That's you want, what do they say? You know, what is the real money doing or whatever? That's what the real money is doing. So there you go. Kirk asking, where can I get the rotation chart? I think there's more than one. Does Stock Charts or somebody like that have it? Look, almost every single thing I use and look at in the Bloomberg is not unique to Bloomberg. I apologize that I don't know how you get it on every other platform, including platforms that I use, by the way. Because since I'm also using this one, this is just where I go by default. I'm quite sure that a number of other services offer relative rotation graphs. Oh, there's actually there's a website, relative rotation graphs. So these guys have it. Stock Charts has it. I'm assuming TradingView has it. And I'm going to... Oh, TradingView doesn't have it. I just heard that. Visualize. Why does it show up here? Oh, publication is ghosted. That doesn't sound good. Here. Stock Charts has got it. So, yeah, there's a number of places you can get it. So what you're looking for is a relative rotation graph. And I think I just heard that Interactive Brokers has it. I'm sure a lot of other brokerage platforms do too. Over a short notice, one-way flight from SFO to JFK on NetJets will cost between $55,000 and $110,000. One way. Yeah. That's a little pricey. So, to have flown out and back, you know, basically dropping $100,000 a day just on the jet, that's a little pricey. I think not. The covered caller, saving money is, if not more important than making money because money saved is no tax. I respect your frugalness. Let me tell you something. Part of it is frugalness, to be sure. But another part of it is, frankly, I cannot afford to spend $100,000 a leg. With the amount of, I mean, imagine that would be just between my California and New York travel each year. I'd probably be spending, you know, at that rate, $1 million a year just on that travel, and you know, wife and kids doing their thing, another $1 million. Yeah. I don't have that kind of jing to throw on jet travel. I have some colleagues who probably do that, and then of course, as I mentioned, I have, you know, some acquaintances, some friends who have planes. And actually, you know, the thing is, the people who have planes are usually not in this business. You know, it's not, you know, either they are, maybe they're in this business, but they are real aviation buffs or freaks. Like the guy that, you know, my friend went down to LA with, he's an avid pilot. And, you know, he's had a number of planes over the course of years, started flying when he was 20, when he was in college. He's a helicopter pilot, he's a jet pilot. He has a amphibious rating, the whole thing. And some of the other people, usually the people that own planes, at least that I've experienced, many of them are business owners. You know, people that own things like car dealerships and stuff like that. That's what we're talking about. So when you end up at Signature and you're walking out there and you're thinking, you know, you're surrounded by all of these Wall Street bigwigs. Well, maybe Jamie Dimon and some of those other people are rolling around in the Gulfstream, but a lot of the other nice planes you see out there, chances are it's not a guy like me. It's not some working Wall Street stiff who, you know, runs money in a portfolio or trades or something like that and makes an okay living, right? There's a big difference between an okay living and working in this business and managing, you know, hundreds of millions or billions of dollars and having hundreds of millions or billions of dollars of your own, which you don't mind spending on jet travel. If I had $1 billion, I can tell you right now, I would be less frugal. How about that? Because there are times when I really would prefer to, just go to the signature terminal, pull your car up, literally you walk out, and, minutes later you're up in the air. It's awesome. But yes, a dollar saved is a dollar earned. Dinesh, thank you for sharing your thoughts on Netflix. How can we get in touch with you and the team? Didn't you just recently? I guess you did get in touch with me via the chat. Drop us a comment into the comment, not the chat section, because it's not that easy to get to. But if you want to reach out to us, by all means, drop a comment into this video once it's done, and we will try to revert. Okay. And you are asking, how abnormal is this recent market move? Well, there is little doubt that about 10 sessions ago, or so, maybe a little bit more, I was starting to see a lot of stuff getting chopped up in ways that had me wondering what was up. I've mentioned this to you guys before, that in the late 90s and into the early aughts, one of the things that I saw was prices were rising and volatility was rising concurrently. And that's a relationship that does hold in things like commodities. So oftentimes you have some idiosyncratic event, oil shoots higher, and volatility in oil also goes higher. Gold shoots higher or silver shoots higher, and volatility also goes higher. But in equities, for the most part, that's not the pattern. In general, and you know this, if the S&P continues to grind higher, the VIX is going to be flat to lower. When you start seeing prices rising and volatility rising, and we did see some of that, that usually means that there's something brewing underneath the surface. And I was wondering a little bit because we started seeing some of these stocks moving around really violently, double-digit moves, and we found out why. Aschenbrenner's fund was, kind of getting beaten up there a bit, and it looked like people were shooting against him too. It's not even 100% clear that they knew who they were shooting against, but probably many did. And, that will happen. It's happened sometimes very publicly. It happened very publicly when Bill Ackman, rightly or wrongly, decided he was going to short Herbalife. He shorted Herbalife, and what happened? Carl Icahn said, "Oh, you're short 20% of the float, huh? Well, I now know your position," and he had something to lean against. This is a market dynamics type of a thing, and I think that if you have a fund that is using 4x leverage and you start to see a certain trade become a little wobbly and get unglued, and other market participants are vaguely aware of what the positions are, they might press a little bit. Say, let's see where this goes, because we know that this guy's short a whole lot of these things using leverage. And if they start to catch a bid, he's probably going to have to cover. So why don't we pick up a little bit? Just playing for a short-term squeeze. He's long a lot of stuff that have had an awfully good run. And he's using a lot of leverage. If it starts to roll over, he's probably going to have to unwind some of that part of the trade as well. Doesn't make them bad guys. You have to read the tape. You have to read the room. If you're sitting at a poker table, you're aware of your opposition's positions, right? You know how big his stack is. And, some of the cards, everyone gets to play them, right? So I think that's kind of what happened there. I'm hoping there isn't a whole lot more of that around, because whatever my feeling on valuation in some of these stocks, and some of them are pretty rich, I'm never, ever rooting for a bear market. I just don't think that's a good thing. I did see a really funny post, and that funny post said, I'm trying to remember. Oh, I think it was Meb Bobber. I think he put it out there on X, and it was something like, imagine, an elder statesman in Wall Street, or a dad talking to a son, mom talking to a daughter, many years from now, and they said, we went through this period where stocks just went inexorably skyward, and we had 20% year-on-year increases in equities, and the younger one says, my gosh, that's incredible. How was it? Everybody was miserable. Whatever we have to be miserable about, we certainly can't be miserable about stocks going higher. That, in general, is a positive sign, and I can just say that even when I see things that I think, that's just ridiculous, it shouldn't be valued there, I'm not really rooting for stocks to decline. I never want that to happen. Will happen at some point, but I'm not sure that we're quite there yet. We are, although I want to say this about the seasonal thing, September is historically one of the toughest months for the market. September is one of the most volatile months of the year historically. People often think about October because that's when Black Monday happened. There's been a lot of crashes Some of the most notable crashes happened in October. September is typically a choppy month. And we're weeks away from Labor Day. So I think that's something to be aware of and prepared for. Mentally prepared, at least. And maybe that's where we'll leave it for today. And I'm very pleased that after I was missing on Monday, that a number of you tuned back in again today. Thank you very much for that. Thank you very much, as always, for your questions and comments. And let us know what you think about this idea that we have. We're just thinking about having, a handful of factors, maybe 3, 4, 5 factors that we would just regularly disseminate the list so people could sort of get an update of what stocks would meet the criteria and which ones wouldn't. If that's of interest, we'd be interested to hear that. We have to figure out, are we short Strangles in Amazon also? We do not have positions in Amazon at the moment in the fund where I am more active. We obviously have material positions where we are long Amazon and short upside call spreads, but we don't have short strangles in Amazon at the moment. So, with all of that in mind, I will hope that all of you have a great rest of your trading week and weekend, and we will see you next week. Thanks for watching.